Hi everyone and welcome to the Manifested e-learning platform. Today I'm going to answer a question, and this question is ideal for students who are appearing in various exams like the Accounting Technician Diploma, the Bachelor's of Commerce, the Bachelor of the Business Administration, diploma courses and so on. The question is in three parts, A, B, C. A reads, outline 2 reasons for the time preference of money, 2 marks. B, explain 4 factors to be considered while formulating the dividend policy, 8 marks. Then part C is a long question that required candidates to calculate the weighted average cost of capital using the market values, 10 marks. First, part A, we will answer part A. Outline 2 reasons for the time preference for money. Now, candidates, the time preference for money is an individual's preference for possession of a given amount of money now rather than the same amount at some future time. The time preference of money, candidates, individuals would prefer to have money now and not in future. The question is, what are the reasons for the time preference for money? If I was to ask you, I have 10 million shillings, and you have an option of choosing to get the money now or 1 year from today. Would you prefer I give you the 10 million today, or I give you the 10 million after 1 year? So candidates, the time preference for money is an individual's preference for the possession of a given amount of money now. Many individuals would prefer to be given the 10 million today and not next year. So what are some of the reasons you would prefer to have the money today and not in a year's time? You can guess the answers. One answer could be that I can change my mind. I can decide not to give you the money after 1 year. Can change. And that's uncertainty. You may not be sure that I will be even alive after 1 year to give you the 1 million. It is sometimes said that a bird in hand is better than 2 birds in the forest. So one reason is uncertainty. We are answering the question A. That's the question. One, I've said risk or uncertainty. Risk. Why? Because the longer a person waits, the more uncertain there will be. The more there will be uncertainty. The longer a person waits for money, the more uncertainty there will be. There is that risk or uncertainty. How certain are you that after 1 year, I'll still have the 10 million to give you? So individuals prefer to have the money today. Now, the second reason is the opportunity cost. Opportunity cost. Because if a person waits for money that person will miss the opportunity to invest the money and earn interest candidates. I would rather give you the 10 million today. That 10 million you can put in a fixed deposit account and earn interest on it, other than wait for 1 year and get the same 10 million. So if we have 10 million today, okay, today, this is today, 10 million. If you are to be given 10 million, assuming there is an annual interest of, say, 10%, this money will increase to 10 million plus 10% of 10 million. But if you wait for this money 1 year, you just get 10 million. So the one who waits for money to get money in future forgoes some benefits. Okay, you forgo certain benefits, the opportunity cost. Because if you had that money and you wait for it to receive for 1 year, then you forgo the 10%. That 10% is an opportunity cost. It is the benefit that is foregone for not taking up the money. So opportunity cost is another reason for the time preference for money. Then number 3, inflation. Inflation is defined as the loss in value of money, okay, or the increase, the persistent increases in prices of item over time. If you get the money now, you can convert that money into an asset that increases value. For example, land. But if you wait for 1 year, the purchasing power of money now is higher than the purchasing power of the same amount of money 1 year from today. Inflation. So these are 3 reasons for the time preference for money. Part B, explain 4 factors to be considered while formulating the dividend policy. Factors to consider while formulating dividend policy. Candidates, a dividend policy is defined as a plan of action adopted by the directors of a firm whenever the dividend decision has to be made. Is a plan of action. So companies must have a policy on how to decide or what to decide when it comes to paying of dividends. And there are various factors that must be put into consideration when developing a dividend policy. The first one is the nature of the business. The nature of the business. Companies that have stable incomes or earnings may formulate stable or more consistent dividend policy because they can easily predict their earnings. For example, a company can decide that we'll be paying our shareholders 10% of the par value of the shares that they hold in a company, because in such a company has stable earnings. So the nature of business. There are some businesses where you can easily predict their earnings. Others, earnings are erratic. So firms which have unstable earnings may follow a variable dividend policy. one that varies every year. It changes every year. But the ones that have stable earnings, they can have a stable or consistent dividend policy. The second factor to consider is number 2, company's age. The company's age. A newly started firm may require much of its earnings for financing expansion programs or growth requirements, and it may follow a rigid dividend policy. Okay? A new company may not have a large capital base. New companies will have to, in most cases, rely on retained earnings, the profits. Instead of distributing profits to shareholders, the profits are retained, so that we have what we call retained earnings. Retained earnings is a source of capital. So if a company is new, a newly formed company, that company is most likely not to pay dividends. It will have a rigid dividend policy in order to do what? To retain most of the earnings. Whereas an existing company, a company that has been existing for a long time with a good track of record and name, can formulate a clear-cut and more consistent dividend policy. A mature firm may not require retained earnings because it's stable. Okay? It has good track record. It has reputation. Okay? It is stable. But a new company may not be stable. A new company may not even get loans from financiers. But a company that has been in business for a long time can easily get finances from other sources. So companies age. Number 3, liquidity. Liquidity position. Candidates, if the cash position of a firm is weak, a stock dividend may be better. That means instead of paying cash, the company can pay the shareholders dividends in form of stocks or shares. But if the cash position is strong, the firm may opt to pay cash dividends, because candidates' dividends can be paid in various forms, like stocks, cash, and so on. So the liquidity position of a company is a factor to consider while formulating the dividend policy. Then lastly, number 4, financing. Financing needs of a company is also a factor to consider when formulating dividend policy. Financing needs. Candidates, financing needs mean funds required for foreseeable future investment. So if a firm has sufficient profitable investment opportunity, if a firm has opportunities for investment, then such a firm should follow a low dividend payout ratio. That firm should not pay dividends. But if a firm has no profitable investment opportunities or few investment opportunities, then it should adopt a high dividend payout ratio. That firm should just pay the shareholders dividends, because these shareholders can reinvest their dividends elsewhere at a higher rate of return than the company holding their money. Because remember, management is, they are appointed to help increase shareholders' wealth. So if the shareholders have paid money in form of capital, and you know that the company does not have opportunities to increase their wealth, then you'd rather give them their money because they can reinvest that money elsewhere. You give them their money in form of dividends. You can give them dividends to invest elsewhere. So the company's financing needs is also a factor to consider when formulating a dividend policy. So these are 4 factors. The candidates were required to give 4 factors, 8 marks. 1, 2, 3, 4, 8 marks. In part 1 here, reasons, these reasons, we gave 3 reasons. 1, 2, 3. How many marks? 2 marks. 1 point, 1 mark. Candidates were to give just 2 reasons for the time preference for money. I'm going to answer question C. It says, the following is an extract from the statement of financial position of FC Limited as at 30th June 2018. There are 2 columns, one for money, the other one for details. Ordinary shares of 50 shillings each, 5.2 million. Reserves, 4.85 million. 9% preference shares of 100 shillings each, 4.5 million. 14% loan notes, 4.5 million, 5 million. Then there is total long-term funds. The total is 19,550,000 Kenya shillings. Additional information number 1, the ordinary shares are quoted at 80 shillings per share. Ordinary shareholders expect cash dividend of 4 shillings per share and a dividend growth at the rate of 12% at the end of every year. Number 2, the preference shares which are unredeemable are quoted at 72 shillings per share. Number 3, the loan notes are quoted at par. Number 4, the corporate tax is 33% per annum required. The weighted average cost of capital using market values. How many marks? 10 marks. 10 marks. Part C. Weighted average cost of capital. I'll use my blue pen. Weighted average cost of capital. Weighted average cost of capital. That's the question. That one is a straight line. This is a straight line. It should be a straight line. Correct. Straight line. Weighted average cost of capital. The formula for weighted average cost of capital is equal to cost of equity times the weight of equity plus cost of preference shares times weight of preference share plus cost of debt times the weight of debt. Because in this question there are 3 sources: ordinary shares, preference shares, and loan notes. These are this is a debt loan note, 14% loan note. So candidates, I'm going to use a table. To determine the weight of weighted average cost of capital. The first column will be the source. I'll have the source. Then the second column, I have the weights. The third column, I'll have the specific cost. And the last column is a weighted average cost of capital. There are how many sources? We have equity. This is ordinary shares. Equity. We have preference shares and loan notes. These are debts. Okay, we calculate the weights. The question says that calculate the weighted average cost of capital using market values. We'll use market values when calculating the weights. We calculate the specific cost then. So candidates, we calculate the weights based on market values, then we calculate the specific cost, then WACC. So I'm going to have a working for weights. Workings. The weights are based on market values. Now, additional information number 1 reads the ordinary shares are quoted at 80 shillings per share. That is the market value of the ordinary share, 80 shillings per share. So we will calculate the number of shares, then multiply by 80 shillings to get the market value of shares. So ordinary share capital. We calculate the number of ordinary shares. And how do we do that? We will divide the par value of 5.2 million, divide 5.2 million by the ordinary share, the value of the par value of a share, which is 50 shillings. These are thousands. This will give us the number of shares. The same thing will apply for preference share capital. We divide the nominal value of 4.5 million by the par value of a preference share of 100 shillings. That will give us the number of preference shares. Number of preference shares. My machine. So let me divide 5.2 million divide 50. These are 104,000 shares. Then 4.5 divided by 100, this will be equal to 450,000 shares, preference shares. These are number of shares. But we read in note number 1 that ordinary shares are quoted at 80 shillings per share. So to get the market value of ordinary shares, we'll multiply the number of shares, 104,000 shares, times the 80 shillings per share. These are 80 shillings per share. Then the market value for preference shares, share capital, is 45,000 times the market price of preference shares, 72 shillings per share, times 72 shillings. Then that is 104,000 times 80 is equal to 320,000. That's the value, market value of ordinary shares, 45000 times 72, and this one is 33,240,000. These are market values of these ones here. Let me demarcate. So these are market values of ordinary shares, market value of preference share capital. Then we will add the market value of the loan notes. Note number 3 says the loan notes are quoted at par. The loan notes are quoted at par. So the par value of loan notes is 5 million. Today is still 5 million. So the market price, the market value of loan notes is 5 million. 5 million. So this total will give us the total market value upon which to base the weights. 8320 plus 3240 plus 5000. 16,560. That is the total market value of the sources, three sources. So to get the weight of ordinary share capital, we will divide 8,320,000 by 16,560,000. That will give us the weight for ordinary share capital. 8320 divide 16,560. 16,560. This weight for ordinary share capital 0.5. The weight for preference share capital will be 3,240,000 divided by the total value, market value, 3240 divide 16,560. This is 3240. Let me take it again. $32.40 divide 16,560. The weight here is 0.2. How about loan notes? I'll take the 5 million divide by 16,560. 5 million divide 16,560 is 0.3. This is million. 0.3. 0.3. So these are weights. That is weight. Then we calculate the costs, the specific costs. These are specific costs. Specific costs. We are going to calculate the cost of ordinary shares, the cost of preference shares, the cost of loan notes. That's the next assignment. This is working number 1. Working number 2, specific costs. We start with the ordinary share capital. Ordinary share capital, cost of equity. This is cost of equity. We know the formula is D naught into 1 plus G over P naught minus or plus G, where D naught is the current is the current DPS, and D naught into 1 plus G is the expected DPS. From the question, which information are we given about the dividend? The ordinary shares are quoted at 80 shillings per share. Ordinary shareholders expect cash dividend of 4 shillings per share. Expect. So this 4 shillings per share is the expected dividend per share. Candidates, you need to be very keen when determining this denominator. You may either be given the current dividend or the expected dividend. If you have the expected dividend, then the expected dividend, I just said, expected dividend is D naught into 1 plus G. So the expected dividend here is 4 shillings. Where you've not been provided with the expected dividend, then you will have to grow the current dividend by this factor, 1 plus G. So that is the expected dividend we read from the question. Note number 1. Shareholders expect cash dividend of 4 shillings per share. Then P naught is a market price per share. The market price per share, we know it, is 80 shillings. We divide by 80. Then we add G. So that is plus the growth rate, which do we have growth rate? We don't have any growth rate. So there is no growth rate. This one is not growing. Okay, there's no growth rate. Yeah, we have growth rate of 12%, and dividend growth rate at the rate of 12% at the end of the year. So I'm going to divide 4 divide 80, 0.5 plus 0.12 plus 0.12. This is equal to 17%. When we multiply by 100, we get 17%. That is the specific cost of equity. We now calculate the cost of preference. Preference share capital. The formula is this one is abbreviated as this is cost of preference shares. KP is equal to DP divided by P naught or PP, okay, times 100. The cost of preference shares is shown there. We've seen 9% preference shares. That's the cost, 9%. So that's 9%. When we multiply by 100, we get the cost in shillings. So that is 9% times 10 shillings. 9% times 10 shillings. That will give us the dividend. Okay, this is the dividend. Dividend over the market price. The market price per preference share capital. Market price. The market price, not number 2. The market price is 72 shillings. 72 shillings. That's the market price. So 9% of 10 shillings, okay, 9% times 10 is just 9, 0.9 divide by 72. This is times 100. 12.5% is the cost of preference shares. How about the cost of loan notes? I'll continue my working here. Cost of loan notes. Cost of loan notes, candidates, the cost is 14%. 14% loan notes. And in note number 3 we read the loan notes are quoted at par, which means the loan note cost is still 14%. But we know the formula for debt. We know this is debt. This is KD. The formula for debt we know is interest over the market value per debt, okay, over market value per debt, okay, market value, the MPS per debt, times 1 minus T. The interest is 14% and the par value is 14%, okay. The interest is 14%. But we've not been provided with the value per note. We don't know the number of notes. We are not given the value per note, the par value per note, but we have the interest at 14%. 14%. Therefore, we just apply the factor 1 minus T, and we know the taxation is 33%, which is equivalent to 0.33 when you convert it into decimal. So that will give us the cost of loan notes. The cost of loan notes is 14 times 0.67. 1 minus 0.33 is 0.67. This is equal to 9.38. 9.38 is the cost of loan notes. So we have the specific cost. That is cost of ordinary shares, 17%. Cost of preference shares, 12.5%. Cost of loan notes, 9.38%. So we'll multiply the weight times the cost. For ordinary shares, 0.5 times 17 is equal to 8.5. Then 0.2 times 12.5 is 2.5. 0.3 times 9.38, 3.3 times 9.38 is 2.8. The total is 8.5 plus 2.5 plus 2.8, 13.8%. Weighted average cost of capital. Weighted average cost of capital. Candidates, alternatively, instead of using the table, you can just use this formula. KE, we have calculated it, is 17%. The weight is 0.5 plus KP, cost of preference shares, is 12.5%. The weight of preference shares 0.2 times 0.2 plus cost of debt, the cost of debt 9.38 times the weight of debt 0.3, this is percent, 0.3. When you calculate these figures, you will definitely get the weighted average cost of capital of 13.8%. If you've done several questions, you may not need to go through the long route. That's why this question is only how many marks? 10 marks, because you need to show your workings. There's marks for workings. If you've done the workings, candidates, you can skip this table because the formula for weighted average cost of capital is KEWE plus KPWE plus KDWE. So you only need to calculate the costs, specific costs, as you have done here. Then you calculate the weights as you have calculated there. Then you apply the variables in the formula to arrive at the weighted average cost of capital. Thank you for joining our today's revision session. In our next session, we are going to continue answering questions from the subject financial management. Bye-bye.